Hello, everyone. Welcome to Money Front's session on market outlook in the rising interest rate scenario. Today, we have with us Mr. Sorbh Gupta, equity fund manager from Quantum AMC. Sorbh Gupta is qualified as a chartered accountant and has completed all three levels of CFA. He is the fund manager for Quantum Long Term Equity Fund and Quantum Tax Saving Fund. With more than 16 years of experience in equity research as well as managing funds, Saurabh brings with him a wealth of experience of having tracked various sectors in his current and previous work assignments. Thank you for joining us, Saurabh, and we are really pleased to have you with us today.
Thank you for inviting me for this session.
Okay. So, Saurabh, the first question is obviously the word which is on everybody's mind. It is about inflation. And now we are also seeing RBI changing track from growth to just trying to tame down inflation. We've seen RBI make a surprise rate hike of 0.40, which nobody even expected. And we're also seeing high inflation numbers like 7.79 in April. So, how do you see the RBI now moving when it comes to increasing rates and trying to tame inflation?
Sure, the inflation is clearly moving beyond RBI's comfort, but I'm sure RBI is also cognizant of the fact that the growth is also not picked up as fast as they would have expected. So clearly they need to balance things out. From a rate perspective, what we see from here on is that currently the repo has moved to 4.4 from 4, bottoming out at 4. If you look at pre-COVID, the repo rates were close to 5. Okay. So clearly the inflation has moved beyond RBI's comfort. RBI's comfort has been generally 5 or maximum 5.5. So inflation is now clearly moving way beyond their comfort, and they will have to raise rates. And despite the fact that the growth rate is not picked up as fast as they would have expected it to be, so clearly they have to do a balancing act over here. From a rates perspective, what we believe is that the first stop would be RBI moving the rates to pre-COVID levels, which was 5.5 at the repo. So we believe they will try to reach that levels of repo rates rather quickly. And from there on, depending upon what trajectory the inflation has, because large part of this inflation is imported inflation, where rate cuts or rate hikes might not do a lot of thing, but clearly RBI has to act. So we believe that if the inflation continues to be a problem even 6 months down the line, repo could move to a longer term average rates of 6.5. So many a times we have seen repo at 6.5. That's the general average repo rate that the country has over last 15-20 years. So we believe that repo could end up there if the inflation is not tamed in next 3 to 6 months. So that's the broad view on the interest rate cycle and the repo right.
Okay. So, while people do understand the reason for rate hikes, finally, at least it ends up pinching a lot of retail people also, because home loans go up and a lot of your lending rates go up. But what happens if inflation is not checked? And there's another term around this called stagflation. So if you could help explain that a bit so that people understand why rate hikes become so necessary at a time like this.
Sure. Okay, I'll do a little more detailed answer. I'll have a little more detailed answer over here. So let's understand inflation first. Now, inflation is just a like-to-like price increase for similar products or service. So if you look at the government data, government releases inflation for a basket of products. If you look at Indian basket of CPI calculation, 50% is food. Right. So inflation experienced by each person is different depending upon consumption basket, right? So people like you and me or others, listeners, etc., might have a very different experience of inflation vis-a-vis a person on the street who have a more exposure towards food. So our consumption basket food would be less than maybe 10%. So inflation for every person is different, but thumb rule is whatever the government is dating, general experience of inflation is over there. So that's the inflation. Right. What happens is there is a secondary impact of inflation, for example, energy prices or fuel prices, which feeds into another production. For example, the fuel price hike might not directly impact you if you're not using a car, but it does impact you because the transportation of goods and services which you are using is using diesel to bring it to your house. Right. So there will be a second order impact of inflation over there. Coming to what is stagflation. So stagflation is nothing but a combination of low growth, and high inflation. And that is the most sticky situation any central banker or any economy can get into. To go back in times, if you look at a period between 2000, say 11, 12 to 2013, 14, in India, exactly that was the situation where growth was slowing down and inflation is very, very sticky. So what happens is when inflation is sticky and high, RBI cannot cut rates to boost growth, and growth is not picking up. Right. So there are very little tools left with the monetary policy to change the things, and people's purchasing power gets eroded, but the growth is not picking up. So it's a very challenging situation, and it can last for a year and a half or two. And it's not a great situation for stock markets as well. So that's the stagflation for you. Now, coming to the third part of your question, why to change interest rates? Now, interest rates, it does is it's cools off demand, because interest cost increases means your EMI increases, your consumable surplus reduces, your ability to consume reduces. This means that the demand cools off a little bit. And because the demand is lower, supply gets its own time to react to increased demand, and the equilibrium between demand and supply is there, so that inflation is controlled. If left uncontrolled, what will happen is eventually the country will end up having a hyperinflation scenario where the predictability of inflation or predictability of future cash flows goes for a toss, and things will be really bad. For example, what happens is, if say the inflation starts to rise day after day, which happened in a lot of few African countries or some other countries, the damage will be that you'll not be able to predict what earnings you want to make. Companies won't be able to predict what kind of cash flows they need to generate for the next set of expenses or next set of capital expenditure. So that whole predictability in the economy goes for a toss. And it's a very difficult situation to come back from. I think that is the reason monetary policies act to stabilize the economy and stabilize the financial system. And that's the reason monetary policy actions are taken.
So if interest rate hikes cool off demand, it could also reduce growth in the short term?
Yeah, absolutely. So there are any monetary policy action is a double-edged sword. If there is an interest cut, it means that the growth it's an impetus for growth. If there is an interest rate hike, it means that the RBI is acknowledging that there is not enough supply of certain goods and services in the economy. So you have to cool off demand. And the reason you are seeing this high inflation is because post-COVID, when it first struck, all the global central bankers cut interest rates. They pushed a lot of liquidity into the system, and for developed countries, they also gave a lot of cash dole outs to their population. So what happened is that people sitting at home got a lot of money, and because they had a lot of money, they started consuming while the economy was not producing anything, right? So there was no incremental production because people were sitting at home, but they got their money. And they started using their money to buy things. And when this happens and the supply is constrained, you'll have inflation. And now that inflation demon has come to hit all of us. Added to that, there are other geopolitical conditions like Russia-Ukraine crisis and other things. That is also exacerbating the things that what we are seeing right now.
So in fact, you've literally preempted my next question. When you mentioned the Russia-Ukraine conflict, we did see one of the major short-term instances was a super spike in commodity prices. Even now, it's finally like a game of dominoes when it comes to oil. Is India going to export it from Russia? Is it not? Is Europe going to act against it? So commodities and oil are obviously largely impacted with this geopolitical conflict that we are seeing. But when it started, mostly people expected it to be much shorter. 100 days in, we are still seeing that conflict play out. How do you see, what other impacts of the conflict do you see arising?
Sure. So look, as you rightly said, most of us, including us, thought there resolution, but that's not been the. So from here, we can go in two directions. One is it remains localized. It remains between Russia and Ukraine. Then what happens is that everybody slowly will adjust to new norms of thing, new level of oil, new supply levels of oil. Let us assume that Russia goes out of the oil market and somebody else replaces to a certain extent. Then oil prices will find a new equilibrium. People like you and me will find the inflation and the prices at an equilibrium, and the world will go on. This is assuming that today's information is the final information in terms of what oil, how much oil will be cut off from Russia, or how gas supplies will be cut off, or how agri supplies from Ukraine will be cut off. So markets and people like us and everybody will get adjusted to the new realities within maybe 3-6 months. The second scenario is whether it escalates. Now, from escalation, will Russia attack, say, another countries who are saying that, neighboring countries who are saying that they will join NATO, right? Or there will be further sanctions on Russia by European countries. Now, I think day before yesterday, they said that they will stop consuming Russian oil in total. Now, that clearly creates a vacuum in the supply in the market, right? So, and then it also puts a lot of question marks on countries like India and China, who continues to buy oil. Earlier, their biggest alibi was that since Europe is also buying, why cannot we buy? Now, Europe is saying that they are taking high moral ground. There will be pressure on countries like India and China to give up Russian oil. So if the escalation continues, and there continues to be a game theory that between the two powers, the Western world and Russia, then there will be that we will also suffer from that grind. So it's a very evolving and very tricky situation right now. But let us assume, let us hope that it remains here. Then markets and everyone and economies will adjust to the new realities, and things will fall back in place. But if it continues to escalate, then it's a problem, and it's a very difficult situation to predict right now.
Escalate and expand in its impact.
Absolutely. Yes.
So, coming to something which will probably be most relatable to investors is that we saw a lot of people getting active in investing really in the pandemic. In the pandemic is also when we've seen, the whole move to financialization of assets really showing a good momentum. So there will be a lot of investors today who've probably seen mostly markets go in one direction, which is upward. Now, when we look at the markets, there are just so many headwinds that we see a lot of reasons for volatility to be there. So two questions. What is the short-term outlook for you when you see the market? How will it play out? And what should investors really do?
Okay. So first of all, we generally prefer investors to look at equities from a more of a at least 3 years perspective. We believe that people should believe that it's an asset class, not a speculative class. So one should have a plus 3-year view when you are looking at equities. So that anchors a lot of thoughts on the longer term situation of how things will play out, not the near term. Near term, clearly, as I said, inflation and interest rates are two variables which the market is trying to get adjusted to. Now, if you look at interest rates, let me talk about inflation first. Inflation, what happens is markets are heterogeneous. There will be some companies who are benefiting from inflation, commodity companies and others. And maybe to a certain extent, banks also get a slight benefit when there is inflation, not hyperinflation, but normal inflation. Second set of companies is neutral companies who do not get impacted. Nothing happens to their business model when there is inflation. And third, companies are consuming companies who take inputs and they get impacted because there is a cost push that is coming, and because the demand is not that strong, they are not able to pass on. So there will be a pressure points on their profitability.
So their
margins will come under pressure. Right? So it will be a heterogeneous mix of what is happening because of inflation. Coming to interest rates, again, there will be two impacts. One impact is when interest rates go up, companies which are levered or which have a lot of debt on the balance sheet will find pressure on their profit before tax or profits because the interest outgo increases. So steering clear of companies which are high on leverage is the most important aspect in current environment, which we are also doing in our portfolio, which we have done in our portfolio. Second is, as the interest rates go up globally, the cost of capital goes up. And cost of capital last 10 years or a decade has been very, very low. And that has resulted in a lot of valuation froth that has come into the market in certain sectors and certain names. We believe that is getting normalized because the cost of capital is the single most determinant of valuations, right? So some of the stocks which move from valuations of 70, 80p, 90p, 100p, so-called quality at any price stock will be the biggest sufferers when the cost of capital normalizes, interest rate goes up. So one has to steer clear of that kind of portfolio as well. So a portfolio which is less leverage and a portfolio which is fair in valuations or very attractive in valuation will do much better compared to a very high or costly portfolio in terms of valuations. That's how the structure would be. Now, people who have just invested over last 1.5 years, they need to condition their expectations from equity. Now, that game of you invest and you make money another day has to change. And unfortunately, in equity markets, people do not understand a lot of talks, but they generally understand when they burn money. So clearly, this will be a harsh experience for a lot of people. And when they see their investments in the red, I just hope that people understand that equity is a longer term game and use this as an opportunity. Now, I've been talking and meeting a lot of people who have been waiting on the sidelines since 2020, and they've missed the opportunity and they've missed the bus. They're always saying that if the market corrects, we want to deploy. But actually, when the market corrects, people just are a little more fearful. So my advice or my sense is that this is the right time. One should use this volatility to get an equity allocation into their asset allocation and play that longer term game and not the near term game. So look, one has to differentiate between equity investing and playing a cricket game online or a Ludo online or a Rummy online, which are a lot of apps. So there is a difference between an equity investment app and an online gaming app. One has to know the difference. And unfortunately, that different understanding of the difference is coming the hard way. That was bound to happen.
It is finally always learned through experience, right? I mean, in theory, you can say everything possible. But, yeah. Okay. One question which was on my mind was that when we look at growth estimates, globally, those estimates are actually being slashed. Be it for developed economies, when for some country like a US, where they are experiencing inflation almost at 8%, whereas their band of tolerance is around 2%. And even for something like a China with their COVID zero policy, now they're again seeing a massive growth estimate cut down. Do you see this global kind of a growth cut down impacting markets? And apart from that, do you believe India is going to face it as bad, or is it a little better, like what a lot of commentators are saying?
So our understanding and our bottom-up understanding of when we meet companies and when we look at data bottoms up, what we realize is that India is going through a cyclical recovery. And now, if you look at last 4 or 5 years, or maybe 6 years since 2016-17, things have been very tough for Indian economy. The growth had been slowing down because of multiple reasons, both natural and man-made. So right from demonetization, then next year was GST, then it was an IL&FS crisis, then COVID came. So multitudes of things happened in last 5-6 years. And what we have seen is that last 4 or 5 years, all the corporates what they have done, good corporates have cleaned up their balance sheets. If you look at banks, they have capitalized, recapitalized, have cleaned up their bad loans and other things. They moved to higher rated kind of borrowers. So a lot of repair works happened in the economy in last 4 or 5 years. And now post-COVID, this is the first cycle of, say, a corporate earning upgrade cycle, if I can say so, happening in last 5-6 years. So we remain very, very constructive on Indian economy and its cyclical recovery. A few other data points which adds to this comfort is the pickup in hiring in IT. I think the pickup in hiring that has happened in last 1.5 years in IT is the highest since maybe 2005-6.
Oh.
And as most of us would know, that IT is a well-paying job, and it creates a real kind of premium or a upper middle class layer which wants to spend, right? So it's a very big lever on consumption aspect of the Indian economy when the hiring goes up in IT. So typically IT companies are the only companies which spend 60-65% of their revenues as salaries. So there is a great multiplier effect if they do well and they hire more people. Second is it's a 20-year low mortgage rate, though it started to move up, but still the mortgage rates are the lowest in the country in last 20 years. And affordability has clearly improved. And you can see there's a clearly uptick in the residential sales over the last 1.5, 2 years. And residential real estate cycles are longer term cycles. It has a lot of multiplier effect in the economy. So that is also a positive that we are seeing. Third, I highlighted clear and well-capitalized banking system, and there is a robust tax collection from the government. So government has the wherewithal to absorb a little bit of pain of inflation, as they did last week when they cut the duty on petrol and fuel and other things. So they have robust tax collection thanks to GST now, which is taking shape, and both in direct tax and indirect tax. And fifth, and last but not the least, government is focused on infra creation, which will create longer-term employee generation, longer-term capital formation in the country. So these 4 or 5 things make us believe that we are into an economic upcycle in India. Because of this whole war and inflation situation, it might get delayed, maybe a 6 months, but we are not getting derailed because of that. So we remain quite constructive in terms of we'll see that earning upgrade cycle in the Indian corporates for next few years. So that's our view on the economy.
So you're saying it could be a delay, but it's not a delay.
Absolutely, it could be a delay, but it's not a derailment.
Got it. So I think I'll just move on to the last question.
Sure.
Just connecting some dots. Basically, when the pandemic struck again, gold did really well, and people started moving towards it. When the Russia-Ukraine war happened, and everybody thought that we are probably into World War IV, the world is going to end. Again, gold did really well. So do you think gold remains a good long-term prospect? And similarly, does silver play the same role?
So if you look at gold, we always, whenever we talk about asset allocation as a house, we always say that gold is the best diversification tool that you might have. So for longer term investors, 20% of your allocation should go into gold, is our view. From here, there are multiple forces which is acting on gold. One, as you highlighted, there is a geopolitical crisis, and in this environment, gold does well. It's not done as well as expected despite the conflict of Russia and Ukraine, is because the US dollar is strengthening because increasing interest rates. So when there is US dollar which strengthens, gold generally does not do well. But now with more and more murmurs about a possible recession next year, as the yield curves have inverted and because of increasing interest rates, there could be a slowdown next year in US. We believe gold will do well in a recessionary environment, maybe next year or onwards. So from a longer term perspective, gold best diversification tool that one could have, and a 15 to 20% allocation to gold is a must. Coming to silver. Now, few of the, I think the regulator has allowed some of the funds to launch silver ETFs, and people are excited about that. But clearly, look, silver is somewhere in the middle. It's partially a diversification tool, but partially it also depends on industrial growth, right? It's like somewhere between gold and copper. So it's not a very clear trade on what are you betting on. Right. So because large part of silver is used in production of lot of things, catalytic converter, and it has an industrial usage. It also has a novel usage. So we believe it's a more of a confused trade. I would rather think that if you want to believe, if you want to clearly diversify, gold is a better option. It's a diversification tool. And if you want to invest in growth and the world doing well, and if you want to bet on the world doing well, it's clear that you focus on equities. So it will be a much more clearer trade than silver. That's our in-house belief right now.
So you're saying silver is basically in no man's land?
Absolutely. So yeah. So look, copper is a proxy of growth and equity doing well, and the economy, global economy doing well. Gold is opposite, and silver is somewhere in the middle. So our view is have some gold and have equities. That's a better combination because you have clear thought of why you are holding anything or whatever you are holding.
Got it. I think you've really answered all the questions very well, and all our investors will really value this conversation. Thank you so much for being with us today.
Thank you, Aparna. Thank you for inviting me. Have a great day. Thank you. Bye.